Okay, let us move to the next slide. I'm going to provide comparisons of depreciation method. The straight line method produce uniform charges to depreciation over the life of the assets. For example, if for every full year you're going to provide 10,000 depreciation, so next year you're going to provide another 10,000 depreciations. Okay, $10,000 of depreciations. Yeah. So the benefit received from the use of the asset are assumed to be received evenly throughout the asset's life. Whereas under the unit of production method, we provide depreciation based on the usage, not based on time. So it varies from one accounting period to another accounting period based on the number of hours or usage of the assets. So from time to time, sometimes we need to revise our depreciation rate and methods. There are two factors that use to determine the periodic depreciation. There is number one is the residual value and the useful life. So small error in estimation occur frequently, but we are generally ignore them because their effect are not material. So the usual procedure is to spread the remaining depreciation over the assets of its useful life. What it means here is maybe you make some error of the useful life. You expect that the asset can last for 10 years, but suddenly after 8 years or the assets is not working, it's not giving you any benefits, bringing any future inflow, economic inflow to the business. So this is what we call as your estimation errors. But the most important thing is we provide depreciation annually. Okay, and we also have the term what we call as impairment loss in case that thing happen, or when you dispose the asset, there will be a gain or loss on disposal. Okay, then we move about accumulated depreciation. What is accumulated depreciation? That is the amount of depreciation accumulated from your date of acquiring the asset until to the financial reporting date. It does not represent a cash reserve built up to replace asset when they were wear out. The accumulation of depreciation account is a contra asset account. I mean, it will be a minus. So the accumulated depreciation is a credit account. Yeah. Why? Because asset is a debit account. So in contra means minus asset account with a credit balance representing that portion of asset recorded cost that has been transferred progressively to depreciation expense since the asset was acquired. So this is what it means by accumulated depreciation. Sometimes we have this issue of subsequent costs, whereby according to the standard, the initial cost and subsequent cost of PPE should be recognized only under the following recognition principle. There is a probable that future economic benefit with the item will flow to an entity and we can measure the cost reliably. So this is the principle in including the cost, in determining the cost of the PPE, the initial cost, as well as subsequent cost. Subsequent cost means cost incurred after the date of acquisitions. We also have, for example, overhaul and replacement of major part. If you have this delivery van, you will incur annual maintenance or quarterly service repairs of the asset. That cannot be included as the cost of the asset. That will go under repairs expense. That will go as your service and maintenance expense because that is recurring in nature. Yeah. But sometimes we have this major overhaul. Okay, major reconditioning and overhaul expenditure are made to extend an asset expected future benefits beyond the original estimate by adding materially to the asset future capabilities to produce good or perform service. I did mention, I give example about the halal taxi. When I look at the Dubizel, I found they are selling it at price of 17,000 dirham. Yeah, I'm not sure whether that car can be used anymore or not because it has run for more than maybe almost 500,000 kilometers. Yeah. So the cost is only 17,000, but certain part of the world, they allow you to replace the engine, Yeah. So the body of the car is still the same, then you are allowed to buy new engine. In certain country, the car is really expensive, so you can buy this used car. Maybe they sell it to this used car, and then they're going to put a new engine. This is what called as overhaul. So from the estimated useful life 0, now the car has a new engine, so it can run for another 5 years. It increase the expected useful life. So in that case, the cost of putting the new engine, the V8 engine, you change to the V8 engine, yeah, 3.5 liter engine, yeah. So it will increase the capacity of the car, the useful life of the car. So that cost can be included as the cost of asset. It go to your balance sheet rather than the repair cost go to income statement. So that is the difference. This one you can put it as the cost of asset because it extend and asset expected future benefits or increase the estimated useful life. Yeah, you change to new engine. This is the car that I mentioned before. Okay, so you put a new engine, V8 engine, 3.5 liter. So it increased the capacity. It's very smooth. It's very fast. Yeah. So it increased the capacity, and this cost maybe 20,000 or $30,000, maybe 20,000. Let's put 20,000. Any figure will go. This 20,000 is your overhaul cost. It should be added to the cost of asset. Cost of asset. So it'll go to your balance sheet. Go to your balance sheet. If you just change the tire, change the tire, this will go to your income statement as your expense. So this is what it means by subsequent cost, overhaul or major replacement cost. For leasehold improvement, if an entity has leased an asset, particularly on a long-term basis, it's a common place for entities to incur additional costs to ensure that the asset is suitable for its own intended use. For example, the entity may incur the cost of constructing a road across land that it has leased or install partitioning on the wall of building it has leased. So this is what we call as lease improvement. Yeah, lease improvement. So it will be included as the cost of assets. So these additional costs are called as a leasehold improvement. So we're going to debit to leasehold improvement accounts. So for depreciation, the depreciation will account for the lease improvement, okay, allocated progressively over the unexpired period of the lease. Okay, same goes to our car before this. Yeah, before this, for example, the value is only 15,000. This is the value is 15,000. The useful life is only 1 year. The useful life is only 1 year. So after you replace with the new engine, now this 15,000 plus new engine 20,000. So the new cost will be 35,000, and this car can last for another 5 years. So what the amount of depreciation you're going to divide to 5 years because it can last for another 5 years. So you're going to provide depreciation based on the balance cost here plus additional cost. So it make you 35,000, and then you can divide by 5 years. Okay. Let me give example on this because this is very easy. Yeah, you can understand this very. Okay, for example, you buy this Camry. Now, I don't want to mention the name here because they are not paying me. Yeah, they so just put a car. Yeah, car. The cost is 100,000. Okay, after estimated useful life, you purchase on 2010, 2011. Okay, 2011. So the estimated useful life is 10 years. So every year, you're going to provide 10,000 depreciation. Every year, 10,000, 10,000 until the last year, the value of that asset is only 10,000 and that this car can only run for another 1 year. Okay, this is the value. You did some improvement, replace the engine, put a new engine, a V8 engine, 3.5 liter. Okay, this costs you 20,000. So now the value of this car, sorry, the cost of this 20,000 plus 10,000. So this gives the new value. The new value in your asset account is 30,000. And because of this extension, the useful life, you only have 1 year useful life here. So based on this estimation, or this procedure, what you did, the useful life now is 5 years. 5 years. So starting from this date, you're going to provide depreciation for 5 years. So how much is this depreciation? 30,000 divided by 5 years. So every year, starting from this date, you're going to provide 6,000 depreciation. 6,000 depreciation. Okay. In certain instances, you can see that you need to replace some parts of the car or you need to service the equipment. So these items, these costs will not increase, okay, extend the useful life, the existing useful life of the assets. It will not improve the existing capacity of the assets. It's just more on maintenance, process. So this cost will go to your income statement as an expense. We call it as maybe service expense, maintenance expense, or repair expense. An entity's supplies of spare parts or service equipment for an asset may be redundant if the asset is retired or discontinued. Hence, the spare part or service equipment do not have separate lives of their own. In this circumstance, the cost of this spare part and equipment should be treated as a separate item of the property, plant, and equipment. If you dispose the assets later on. So the property, plant, and equipment are normally divided into functional group with a separate general ledger account and accumulated depreciation. We have account for the assets and account for accumulated depreciation. So the subsidiary ledger record provide information for the preparation of income tax return or to support any insurance claim in the event of loss from theft or accidents. So the record also contain information for preparing the year-end adjustment for depreciation and space for entries to record disposal of assets. So for property, plant, and equipment, you must record using two accounts. Number one is the cost. Number two is the accumulated depreciation. So disclosure of property, plant, equipment. This is the last part. For general purpose, financial statement is required under IAS number 16 or AASB number 116 that the depreciation method used, the useful life or depreciation rate, and the aggregate depreciation need to be disclosed. You have to disclose this in your financial statement. Furthermore, both costs of depreciable asset and their accumulated depreciation must be shown in the financial report. You must report both costs and accumulated depreciation. And accumulated depreciation is disclosed as a deduction from the asset or class of asset to which it relates. Okay. So for example, this is just an example. We have non-current asset, we have property, land, we only have the cost, we don't have depreciation for land. Yeah. For building, this is the cost of the building, this is the accumulated depreciations. Okay. Some say building will not have depreciation. Yeah, that might be your argument, but yeah, maybe they have a longer, very long useful life, yeah, compared to car. But if you don't maintain the building, they might have some value. You need to repair the building, you need to reconstruct the building, demolish the building, and construct a new one. Otherwise, it'll be a haunted building. Plant and equipment, this is the cost, this is the accumulated depreciation. So this is the net book value. This is, I call it as a book value or carrying amount. This is the book value. Okay. So what are the ratios related to assets or non-current asset? The first one is average percentage of useful life expired. That is the accumulated depreciation divided by average recorded cost. Okay. Average useful life in years is average recorded cost divided by depreciation expense. Asset turnover, net sales divided by average total assets. So this gives you the measurement of the capacity of the assets to generate sales. So this is just a ratios that we normally use. Okay. And then I'm going to look at this interpretation, yeah, the management decision, the planning and financing of capital investments such as the replacement of equipment, expansion of the product facility or introduction of new product line is important area of management decision making. So this is known as capital budgeting, where you want to buy new assets, new machines, new building, new PPE. Okay, so this involve a replacement. Whether you're going to replace, you're going to buy a new one, whether you're going to expand the existing capacities. So in short, you have discussed the nature of the PPE, the cost of PPE, how we're going to do with the lump sum payment of multiple assets, the basic for acquisition of asset under lease, and we spend a lot of time on these depreciations, how to determine depreciations, the concept of these four types of depreciation: straight line method, reducing balance method, based on sum digit as well as based on usage. So how should we account for subsequent costs? Subsequent costs mean after the acquisition date. And how we're going to record the property, plant, and equipment into ledgers. We have two ledgers. There is a cost, another one is the accumulated depreciation. Okay, how to report this, and also some ratios relating to property, plant, and equipment. So I think with that, I'll end this lecture. We're going to do one long question after this. Thank you so much.